Hey everybody, welcome back. So today I'm going to be talking about the possible stock market crash or correction that a lot of people have been talking about, and I want to talk about how you can anticipate that, protect your investment, and what you can do to sort of get ready in case there is some kind of correction or stock market crash. Okay, so a lot of people have been talking about the impending crash. They think, that's going to happen pretty soon because the stock market right now is so overbought. The last year, it's just gone up so much. Today, I'm really not going to be talking about, like the indicators, or I'm not going to pretend that I know when. I don't think anyone knows when or how it's going to happen. But I do think, there can be some kind of correction in the near term future, especially because the Fed has to deal with, inflation, even though most people believe it's gonna just pass by. I don't know. But we do know that there's a lot of money in the market right now. In the last year, the Federal Reserve has just print a ton of cash just to combat COVID and a lot of the destruction it did to the economy. But now there's a lot of money circulating, and so yeah, I just want to give you a couple things that you can consider doing in case there is some kind of correction. Okay, so the first thing that I think you can do is really just to have cash on hand. Okay, so in addition to having 12 months of reserve, in my opinion, I think it's good to have money to buy into the stock market. Okay, so whenever there is a crash, yes, it is something that hurts a lot, especially if you have to sell your investments. So you don't want to be in a position where you have to sell your investments if there is some kind of crash. But on the flip side, if there is a crash, those are always really good buying opportunities, right? So everything becomes on sale, and that's when you want to hop onto the bandwagon, especially when everyone is fearful. Like Warren Buffett says, be greedy when everyone is fearful, and be fearful when everyone is greedy. So right now, it seems like everyone is more, I would say, on the greedy side, and therefore I think it's good to be a little more fearful. So therefore, I personally keep about 30% in cash. This is not any kind of financial advice. This is just something I'm doing myself. And before I continue, I just want to make sure to ask you to smash that like button if I do provide any kind of value, or if I provide any kind of information that is helpful. Leave a comment below, subscribe. I would be happy to answer any questions and more than happy to produce any content that you would like for me to produce. Okay, so again, the first one is just to have cash. And again, it's cash that is more than just a reserve for your basic needs. And I would say on top of that, right, this is really a bonus tip that goes hand in hand with number one is aside from having cash, something that's really, really powerful to have that a lot of wealthy people do right now is they borrow or they have access to margin. Okay, so what margin is basically money that you can use or money that you can loan that is borrowed off of your equities or your home. Okay, so I would say the latter is a little more risky because you never really want to put your home in jeopardy. But if you borrow against your equities, it's actually not. It's actually a really good idea, in my opinion, because especially if you can get a pretty low interest rate. So I recommend Interactive Brokers because it has such a low interest rate of 1.59%. So let's say if you invest right now $3,000 into Google stock, I believe in Interactive Brokers you can get, I believe it's up to 50% of your position or positions. So meaning that if you invest $3,000, you can get $1,500 at a low interest rate of 1.59%. Okay, so why that matters so much is because even if you don't have a ton of cash right now, if you have money invested into the market, then you can actually borrow against those positions, and you can just buy into any stocks that for like that you're confident that's going to go back up, borrow, sell it at a higher price and just pay back the 1.59% that you borrowed off of. Okay, so margin is extremely powerful. I highly recommend it. Interactive Brokers is a brokerage that I would definitely go with. I don't think there is a brokerage that has any lower interest rate. If you do know of one, let me know. That's something that I would definitely take a look at. Okay, so in addition to having cash, the second thing is because this channel is called Invest with LEAPS. Okay, so then my recommendation would be to invest in a LEAP option. Okay, so what is a LEAP option? Oh, I talk about this so many times in several of my videos, but just as a quick refresher, a LEAP option just is a call option that gives you the right but not the obligation to buy 100 shares of a stock at a future price. That's usually set a year or more. Okay, so I'm going to give you a visual because sometimes visuals are a lot easier to understand than if I just told you what it is. So right now, this is a real example. I am long-term bullish on SoFi stock. SoFi is a fintech disruptor that is just huge. It's growing rapidly. I think it's going to disrupt the whole industry. I believe 10 years from now, SoFi is definitely going to be up. And so the way you would buy a LEAP option is you would go to, and I use Robinhood because Robinhood has a really clean interface. So I would go into Robinhood. I would do buy call options. I would set my expiration date to a year or more, so January 2023, and I would buy a call option at in the money price. So meaning that the price would be below the current share price. Okay, typically whenever I trade any kind of call options, I do take a look at the deltas. So deltas just tells you the probability of your option making profit and how much it moves in relation to every dollar change of the stock. Okay, so the theta tells you how much the stock option would decay. So every option would decay. The value of the option becomes much less as it gets closer to the expiration date. And so you typically want a pretty low theta just because you don't want your option contract to decay so rapidly, which a lot of people do, honestly. They buy short-term call options, but quite frankly, like long call options aren't that much more expensive than short call options. So I would definitely consider LEAP options because you have so much more time for your thesis to really play out. And in case of a stock market correction or crash, then you have a lot more time for the stock to bounce back up. Right? We know that most of the time stocks eventually go back up. And if you're in a lot of short-term call options, if there is some kind of crash or correction, then you are screwed. But if you're more long-term, if you buy a LEAP option, then you have a lot more time for the stock to recover. Okay, so that's number 2, buying LEAP options. And then the third one is you want to buy value stocks. Okay, so value stocks is just stocks with a relatively low P/E ratio. Okay, so P/E ratio is a price to earnings ratio. It just tells you how much money the company earns in relation to the value of the stock. Okay, so I personally like to use finviz.com because it tells you a lot of different indicators. The P/E ratio, for example, on this Pfizer stock is at 14.65. And so you want to see it relative to the other stocks in the industry. Generally, P/E ratios of, I would say 20, 15 or less is pretty low. If you take a look at Tesla, it's right now it's trading at, I think it's like 396 for their P/E ratio. So it's very different, right? Of course, the industry is different, but that's just something that I think is very, very good to look at. Okay, if you look at Yahoo Finance, you can also look at some of the financials. You want to make sure you invest into stocks or companies that have a healthy balance sheet. So if a stock has a lot of debt, but they're not making a lot of income, or if they don't have enough money to get them through the next couple of years, then you typically want to avoid those stocks. Okay, so if you look at Yahoo Finance, it gives you a lot of great information about financials. It gives you a lot of great information about analysis. You just take a look yourself, and you can definitely find out, revenue, cost of, gross profit, operating income, a lot of information that is very good to know if you're invested into a stock company. Okay, the last thing I would do to really hedge yourself against any kind of correction or some kind of market crash is I would really just exercise the wheel strategy. I know that sounds kind of unorthodox. Most people would know what the wheel strategy is. Would ask me, well, why are you selling puts and selling covered calls during this time? Well, in my opinion, if you're really long term on a stock that is going to be up eventually, then why not earn a little more premium during this time? Okay, so let me just show you what a wheel strategy is. If you believe a stock is going to go up, you want to get in on the stock really at a great price, right? So you can sell puts. Okay, so selling puts, what that means is you are selling a contract that forces you to buy the stock at a certain price. Okay, so if you sell a put at, for example, SoFi at $22, you're saying that if the stock drops below $22 by November 12th, which is in 1 week, I'm going to be paid $100 in premium, but I'll be forced to buy 100 shares of SoFi at $22. Right? Again, if I'm bullish on SoFi long term, I don't mind getting a stock at a discount and getting paid a premium to buy that stock. Right? That's an amazing deal to me. That's what Warren Buffett uses in his portfolio. And again, if you're long term on this, that is really a no brainer to get a stock at a cheaper price and get paid a premium. Okay, and how it becomes a wheel is if you do get assigned the stock, if you do have 100 shares of stock, you can turn around and sell covered calls, which just basically means that you're telling the option holder that you will be forced to sell your 100 shares of stock if it goes above a certain price. Okay, so let's say I have 100 shares of SoFi. If I sell a covered call at $24.50 next week, if SoFi jumps up to over $24.50, I'll be forced to sell my 100 shares at a higher strike price, and also get paid a premium. So the reason why that's great is because, if the stock moves sideways, then I can just keep the premium, right? But if the stock goes up, I make money off of the realized gain, and I also get paid the premium. So I think the wheel strategy is good, even if there is some kind of correction, because like you're collecting a premium and you're getting a good price or better price on a company that you don't mind owning long term. Okay, so in the end, it really, I think, I think if you're long term on a stock, it really doesn't matter, especially if you're collecting premium, and you can always just buy in more at the stock at a later price if you do have a long term outlook on that stock. Okay, so I think that's pretty much it. I just want to keep this short and simple. I don't think you really need to do a whole lot in addition to that. I think just keep your portfolio relatively simple, relatively manageable, and I think just what I would say is don't panic sell if there is some kind of correction. That's really the worst time to sell. In fact, whenever there is market crashes or market corrections, those are really great opportunities to buy. Okay, a lot of people will tell you buy commodities, buy gold, buy silver. Those could be great ideas, but what I would say is just go with the fundamentals, do what you know is good long term. And I think if you truly are long term, then in the long term, you will be up and you will realize pretty great gains. Okay, so I hope this content's helpful. Again, if you like my content, make sure you smash that like button, subscribe, leave a comment below. Until next time, guys, I will see you then.